Today I will be talking about the relationship between stocks and presidential elections. Before discussing the connection between the two, let's go through some basics about stocks. A stock is a security that represents partial equity in a corporation. Investors buy and sell stocks depending on their confidence in the market going forward, as well as current market conditions. The stock prices you may see on television or online is the price of a single share in the corporation, which fluctuates throughout the day. Purchasing more shares means you own a larger portion of the company. One of the main indicators of how the stock market is performing are stock market indices. The S&P 500 is a stock market index that tracks 500 of the largest corporations in the US stock market. Historically, staying invested in the S&P 500 yields much higher returns than only investing when a certain party holds the presidency. Stocks will generally continue to rise in the long run, which is why it can be risky to try and time the stock market based on who is in office. US stocks historically do tend to have a lower chance of losing money during election years. While history may suggest it is a good idea to invest during an election year, it is also important to remember that elections do not guarantee anything. There is no specific set of rules to abide by or major trends to follow. Election years have been slightly variable in the past, with most years being positive, but some negative years mixed in as well. Most losing years for stocks have been world events, like World War II or the 2008 financial crisis. Political elections have not related to losses in the stock market, but major world events like those can heavily impact the market. Despite the uncertainty in 2020 during the coronavirus pandemic and the upcoming presidential election, the S&P 500 still had a positive year. As expected, election days are more volatile than normal. There is a lot of uncertainty revolving around who will be elected as president, as well as who will be elected to Congress. Markets will react instantly to the latest news and results surrounding the election, including any last-minute polling or breaking news that may help or hurt a candidate. According to Dow Jones market data from 1970 to 2022, the S&P 500 changed by an average of 0.32% on election days. While this number sounds inconsequential, this is 10 times more than the average for regular days during this time. Investing in the short term based on specific parties, policies, or sectors can be extremely risky because of this volatility. A great example of election volatility was during the 2000 election. As you may remember, the election was contested and the results were unknown for several weeks after Election Day. Uncertainty grew and the stock market dropped 8.5% during that time. Once the results confirmed George W. Bush won, the stock market returned to its pre-election levels by December 4th of that year. Election results make investors more confident about what policies will be put in place. In a similar light, stocks tend to do better under a president's second term, since investors are more certain about policy and job performance. The outcome of elections has had very limited effects on the medium to long-range outlook of stocks. As mentioned before, major events as well as economic conditions have the biggest effect on the market. Falling inflation has been associated with returns above average, while rising inflation has corresponded to below average returns in the long run. Both stock and bond markets are slightly impacted by the political outcome from US presidential elections, but there are many more important factors to consider. The key takeaway is to pay attention to the economic landscape, like interest rates, as well as world events that may affect stock prices. And remember, election outcomes will never guarantee gains or losses in your portfolio.